Hey, everybody, welcome back to What Are We Missing? I'm Garrett Baldwin, the editor of Me and the Money Printer on Substack, and, of course, the host of this show. And this is the show that treats Wall Street and finance with the respect and reverence that it deserves, which is none. Last week, we dug into leveraged hedge funds, leveraged investment funds, leveraged ETFs, and the next bailout machine, and the products that were built to act like a shortcut but really behave like a trap door. And today we're going to talk about something quieter and a lot worse, the death of retirement investing and stock picking. And I don't mean that as a figure of speech. Now, as I mentioned last week, I've changed this show up a little bit. I'm not inviting guests on. I'm using this as an opportunity to just scream out into the void. Because when you spend the entire week working 15, 16 hours digging through Wall Street analysis, watching price action, and seeing that the market operates a lot differently than what we see on TV and the way it is described through Wall Street sell-side research, I need to simply scream into the void. So here is the promise that I'm going to be making to you, because I need you to trust me over the next hour if you plan to stick around. You will not need a finance degree for this, and you're not going to earn one as well. Not one, not a master's degree in economics. I don't care if you've never read Barron's before. Every single time that this industry takes a normal, boring transaction and hides it in an expensive-sounding word, we're going to stop. We're going to translate that word back into normal English, and then we're going to find out who handed over money, who took some money, who skimmed a fee off the top, and who got left holding the bag. Shockingly, you're going to find that it's usually a retail investor who is stuck taking on all of the risk. And that is the entire method of this show. Follow the money, translate the nouns, and see who the invoices are sent to and who actually sends them. Now, once again, here is the thesis before the music plays in this episode. And I want you to just see it for what it is and understand this is how the markets actually operate today. So, 10 years ago, an analyst at SocGen argued that the math underneath the retirement industry had quietly collapsed. The industry's answer was to lean back harder into the automatic machine that buys the same handful of stocks out of your paycheck every 2 weeks. And they do so forever and never once asked, what is any of this crap actually worth? That machine did not just change the market, it ate it like Pac-Man. And then the same bank that wrote that warning back in 2016 wrote a second one in June. And it says out loud that real stock picking is now close to pointless. So follow this sequence, please. My God, we built a market that runs on autopilot. We funded it with your paycheck. We propped up the plumbing with the Federal Reserve, other central banks around the world, and the Treasury Department. We wrapped the whole thing in fees. And then on the 4th of July, everybody, the government started handing federally seeded index accounts to newborn babies all across the country. $1,000 of Treasury money for qualifying babies whose families signed them up, defaulted into the broad stock market, which means that somewhere right now in the maternity ward, a family is filling out a federal form and a baby that can't hold up its head is waking up with a retirement portfolio and benchmark risk. We are going to get there. I promise. You are going to want to be sitting down, maybe pouring a drink, maybe getting just Uber Eats delivered to you. Again, as I said, close the door. Don't tell anybody that you're in there. And if you need to, just leave a note saying that you are working on ensuring that you are staying up to bat on your certifications. This is the show, how an industry that was supposed to help you invest quietly relocated the act of investing to somewhere you will never see it. And then, before the ink dried on all of this, on this obituary that we will discuss today, it offered the machine to your kids. So the question in this one is basically in the title, as always, what are we missing?
What if I told you Since the first day you stepped into my office, there are 3 ways to make a living in this business. Be first, be smarter, or cheat. Now, I don't cheat.
All right, so what are we missing? Well, that's the entire point of this conversation and what has happened to the retirement industry over the last 30-plus years. And the answer is, well, it's going to require a little bit of a obituary, but that is why we are here, and that is why we dig into this stuff, and that is why we create nice little presentations that people can follow. I mean, wow, what a special treat. Here it is, 10 years ago, all right? There was a strategist, is a strategist. Don't use the past tense. The man's alive. He's fine. He's a real person. His name is Andrew. It's Andrew Lapthorne, and he runs the quantitative research desk over at SocGen. Now, why does that matter? Well, it matters because he wrote this thing 10 years ago. He wrote a note to clients called The Death of Investment. That was back in 2016. Then this June, he writes 10 years to the month. Same man, same bank, another report, and it argues that indexing has made stock picking close to pointless. So, one more time for my friends in the back, read them together. 2016, the death of investment, that the return math was dying. And then in 2026, the argument is that picking stocks, the math behind it is dying too. Same author, same desk, 120 months, one diagnosis, then the autopsy. Now, I want to be careful right off the bat because I don't want to get any angry emails. And I know the lazy version of any of this will get me in trouble. Fine, okay? This is not a secret meeting. There is no room where men in cloaks decided to do this to you. It is worse than a conspiracy because a conspiracy you can actually arrest. This is a set of incentives. And again, I point out all the time, it is incentives that create this Frankenstein monster. It's a lot of independent actors all acting with their own interest in mind, and that brings us here. Because if everyone follows the same thing, if they follow things rationally, one quarterly decision at a time, until they built something that nobody would have voted for on purpose. And that's going to be the finale of this conversation, right? You come to find out that you are compartmentalized and part of a bigger machine, and then in the end, you realize what you have built. The strong version of this is not that passive is evil. The stronger version of this conversation today is a paper trail, and that's what journalism is about. Go Cats! Start in 2016. The note is public. It was written at the time with Bob Bryan at Business Insider. So you can go accuse me of reading tea leaves. Nope, can't do that. Go look it up. Lapthorne takes a plain retirement portfolio. He puts half of it in global stocks, 40% in government bonds, 5%, you can read the screen, 5% cash, 5% corporate credit. Great. $100,000. Okay, so a 20-year horizon, the exact boring mix still inside millions of traditional retirement accounts right now, possibly yours. And what does that deliver? In the analysis, he runs the after-cost excess return. And what does it show? Well, here's our first translation that I promised. Excess return. It sounds like a scandal. It's not. It just means the reward the portfolio was expected to earn above a very safe, boring baseline after the industry takes its cut. That's it. So what is left, right, after the market for you does what it does and professionals remove their share? And in this note, invested in 2016 for 20 years, that leftover projected amount is about $21,800. 10 years before that, the same exercise gave you about $60,000. 30 years before that, about $150,000. Now, I realize I probably should have wrote 1996, but hey, 30 years, okay? So the reward for handing you money to the market for 2 decades had fallen from 150 grand to 60 to 21 and change. Okay? And while we're here, one more word, because they're about to use it 200 times and you can count on flitching multiple times. It is the term basis point. A basis point is 1/100 of 1%. 100 basis points equals 1%. That is the whole definition. Do a shot. You have learned today. Wall Street invented a tinier unit of measurement because saying we quietly remove 1 full percent of your money every single year sounds like a little too much like a confession. So they chopped it up into 1% of 1% into 100 pieces and started charging in gravel. 100 basis points. Doesn't sound like anything. It is 1% every year, forever. So remember that, because I'm not doing this again. I'm not defining this term again. If you don't get that, have another drink. So the portfolio in the note was expected to yield roughly 199 basis points, which is 1.99. Okay, and lose about 100 basis points to cost. 199, 100 brings you to a translation. It earns about 2% above the baseline, and the industry takes about 1 of it. Half the reward is gone to the people standing between you and the market. Now, I have to be honest, or the whole thing will fall apart. Very fair. That was a forecast. That was not a death certificate. Lapthorne said might. Stocks then went on a tear for a decade and made a liar out of the number, so it was not a corpse. And keep in mind, the central bank and the activities that the central bank has engaged in, lots of quantitative easing, lots of other efforts all around to ensure the stability that helped prop up this market and helped accelerate it. This said, it was the actuary finding a faint pulse, looking at a chart, looking at a family, and gently asking whether anyone had considered picking up additional shifts. Because his real conclusion did not need the forecast to actually be exact. It took us exactly where we are today. His conclusion was one sentence. The future, those with the future obligations, are going to have to find more money. Those with large future obligations are going to have to find more money. And that gives you a couple of choices. Find more money? Where? Where would you like to find that money? Is it behind a furnace? Is it in the sailboat that's in the sailboat retirement pamphlet that we're going to talk about? Is there federal money drawers in the house that we don't know about? Rick has a mortgage. The average person, we're going to call him Rick, he has groceries. He has health insurance that covers everything except the thing that happens. Rick has a second kid on the way. He has a furnace that started making noises, and it's a very specific noise. It's a noise that sounds less like a furnace and more like a furnace that needs a lawyer. Okay? So, because that is what find the money is. It is not advice. Work longer, save more, take more risk, accept less. It's what an institution says when the arithmetic has failed and the institution would prefer not to be the one to say it out loud. The return assumption broke. Somebody has to eat the difference, and the plan is Rick. The plan is always Rick. The plan is always the investor. Work longer, save more, take more risk, take on more leverage. Learn how to trade options. Learn how to trade leverage. Learn how to trade Forex. Accept less. Have a lower standard of living. Do all 4 at once. And please complete a satisfaction survey once you leave the webinar talking about what we're doing here. You ever taken one of those webinars? They send a webinar and they ask you about the experience of being told to find money that doesn't exist. There is a 5-star rating scale. 1 star is, I didn't find the money. 5 stars is, I found the money. Who the hell ever gives 5 stars? And yet, they keep sending that survey out. You know what I keep imagining? I keep imagining there is a find more money task force somewhere at the Federal Reserve. There's a conference room. There's a whiteboard, and there's a top of a whiteboard, and it says in dry erase marker, "Where is Rick keeping additional money?" And Susan, who you will meet, Susan has been issued 2 laptops and 17 browser tabs. And Susan has been assigned to locate additional money inside Rick's 70s, inside the decade of Rick's life when his body stops generating payroll. That is the asset now. That is the new asset class. Rick's remaining time on Earth. They ran out of return and they mailed the invoice to the human body. They are going to reclassify childhood as pre-employment. I swear to God, give it a few years. Somewhere there is a slide that says leisure is an unfunded liability. Anyway, they did not repair the assumption. They collateralized Rick's remaining lifespan. The industry read that bill, and it responded rationally. And that rational response is the machine that we are about to build together part by part until you can hear it running under your floor. So let's meet Rick Malloy. Be fair for 1 second, because the cheap version blames a villain, and there really isn't a villain in this whole film. Index funds have existed for decades, okay? Automatic sign-up was already spreading, especially after the 2006 law. It blessed a certain kind of default fund as the place your money lands when you don't do anything. The machine was already under construction, and Lapthorne did not build any of this, okay? I do want to just point all this out before I get to this guy. He just described the moment weak returns pour jet fuel on all of this. And when the reward shrinks, every fee feels heavier in finance. Every expensive failure feels dumber. And the cheapest, most automatic option quietly will, as we will explain, eat the whole freaking system. All right, let me get back to Rick. Sorry, side tangent. I do that. Okay. Give this man his money. Gives that man his money. Rounders. Give the money an owner. His name is Rick Malloy. He's 39. He looks, that's a 39-year-old guy. He does procurement for a county water authority. That is a dream job. And that means he spends his day making sure the water works, and no one ever thanks him for it. You should send this man a letter. He has a mortgage. He has a second kid coming. He has that furnace that we talked about. It has now escalated from a noise to a presence. Rick puts in 6% of his pay. Why? Because the county matches that, right? His employer adds money on top of what he does, and translate that fast because it matters. The match is not a gift, and it is not a trick. It is part of his compensation that only shows up if he chooses to participate. That is important. Turning it down is turning down a raise. So Rick, correctly, does not turn down a raise. Every other Friday, $312.64 leaves his paycheck before he even touches it. And here's the fun part. Rick has chosen the 2055 fund. Now, this is the part where I have to slow down just a little bit, because this one product is the whole conversation in miniature. These are called target dated funds, okay? And here's what they actually are. It is a fund that owns a bunch of other funds. That's the entire innovation. It is a bucket of buckets. You, the worker, pick one thing and only one thing. You pick the plan that has a year attached to it. It is the year that you plan to retire. Plan to retire is a very important word. Now, Rick might have chosen 2055. And based on that single number, the fund runs a preset recipe that slowly shifts Rick from stocks when he is younger, largely into bonds as he ages, on the theory that he will want less risk as he gets closer to needing that money. And that's because we're going to get to a termination called sequence of return risks. Ugh, it's too early for this. That gradual shift has a name too. It is called, in the world of financial planning, the glide path. It's like a plane landing, very soothing, very aviation. And I want to be fair because I am about to be very unfair. The product is genuinely useful for a lot of people. It is cheap. It is automatic. It stops people from panic selling at the bottom and buying Beanie Babies at the top. It is real value. I will concede that. But look at what Rick has actually decided. A guy like Rick did not choose the companies. Rick does not choose the bonds. Rick does not choose the moment the recipe shifts him out of stocks. Rick chooses a year, and that year is 2055. And the year makes every decision for him after that. He has outsourced his entire investment judgment to a calendar. And here's the thing about 2055. That year doesn't have an opinion. That year is a mandate. Mandate's a very important word that we're going to learn today. The year buys what the recipe says to buy. And when the recipe says to buy it, at whatever the price is, whatever it is, whatever that price is, forever. It doesn't sit around and look at what the price to earnings ratio it is. Who gives a damn about EV to EBITDA? We're not doing value-based investing. We are simply looking at a bunch of boxes and a bunch of names, and then we are, based on that date, we are buying it, and we are price agnostic. So once again, who knows what this is actually worth or what it could be worth in the future. And if you're buying some of this stuff at this date, when the markets are extraordinarily stretched, what happens if you have a 30-year period of no growth, no acceleration? Well, that's where the market actually becomes less of a retirement mechanism and more of a term that I don't want to use just yet. Okay, now, Rick has been told that he is participating in the stock market. He tried to understand that once. People do. They do. You know where most people learn about their retirement funds and their retirement accounts? They learn about them in a benefits webinar. And let me tell you something. There is nothing more problematic than having a finance background and going into a company benefits webinar with a person who doesn't have a financial background. I'm just going to be honest. A woman named Dana holds this thing up for Rick. She runs the county. The benefits. She went to a retreat once, had a couple conversations with people. She gets it. She understands it. And she will share her screen during a webinar. They're not going to do this in a room. Why on earth would they do this in a room with people? Why would they? Nope. Dana explains in the voice of a hostage reading a statement that the fund would grow more conservative as Rick approaches his retirement. And Rick, God bless this man, asked a real question, which is what you should never do because you're not going to get an answer. Rick asks what happens if bond yields stay below the number the whole plan is counting on. What happens if U.S. debt blows out and 6, 7, 8% becomes an issue and bond yields move at a specific level? Or what happens if it goes the other way? What happens if bond yields move lower because of a potential crisis? Think COVID. Well, this is the answer that Dana might provide. Well, Rick, that's a very good question, but that question falls out today's retirement readiness journey. And Rick might say, well, it's a question about whether the retirement fund works. And Dana would reply, correct. Today's journey concerns readiness. And then the chat is closed and she disables the chat, and the chat never developed a thought. I've been in this where they've disabled the chat. I've read the Lapthorne note. I read the Besson Binder study. I read the Federal Reserve Monetary Policy Report. And Dana disables the chat because Rick asked a math question. Rick asked if the numbers add up, and Dana's sitting in a fluorescent room reading nothing and wearing a headset, looking at her screen, and decided that Rick was threatening the readiness journey. She didn't answer him. She muted him. She muted the man who was funding the entire $47 trillion system out of his paycheck because his math question was not on the approved agenda for the webinar. That is the violence of the system. It's not a guy in a suit stealing your money. It is a woman in a pastel blouse disabling a chat window because you asked if math works. Up on the side, the whole time, in the background, was a sailboat. There's always a sailboat. Retirement marketing runs on one paragraph, and a couple, usually 60, silver-haired, laughing on the deck of a sailboat at what appears to be 4 p.m. on a Tuesday. And I need you to notice something about this sailboat. Nobody in that webinar owns that sailboat. Dana doesn't own the sailboat. Rick's never going to own a sailboat. That sailboat has no mortgage. That sailboat has no furnace. That sailboat has never been once on hold with Medicare. The sailboat has no liabilities of any kind. The sailboat is the only participant in the entire American retirement system that is fully funded. Because the honest paragraph, the accurate one, would be Rick at 68 at his kitchen table resetting a password for the 4th time to log into a portal to look at a number he is not allowed to ask questions about, eating store-branded cereal while the furnace files a motion. That is a real slide because you cannot sell that real side. They sell the boat. So, let's follow what happens to $312.64 because it is the marble rolling through the entire machine. The contribution arrives and the mandate is bought, the targeted date fund. No new opinion is required. Paycheck, target date, index, giants. I want to repeat this to you because I want you to hear this from me more than once. The contribution arrived. The mandate bought. No new opinion was required. That is the entire U.S. retirement system today in 3 sentences. Meanwhile, while all this is going on in that webinar room, there is unnoticed, a small raccoon, and it does not work there. And he's very important to our conversation. Nobody knows how he got in. He simply watches the contribution vanish into the index. He does not blink. But remember it. It's going to keep getting promoted over and over and over again. Right now we have $47.5 trillion sitting in the U.S. retirement system. Some of these totals will move around from quarter to quarter, so I'm going to round because precision here creates more theater than truth. The scale is the point. $47.5 trillion sitting in retirement accounts. About a third of that, right? About a third of that will be into different buckets that we're going to discuss. Of the total assets, the total financial wealth that households have in the United States, this is about 30 to 35% of all of it. Roughly 18 trillion of this is in IRAs, 14 trillion, which is that 13%, 33%, that's in workplace plans, and nearly 10 trillion in 401ks alone. So translate the boring one. This is the one that I want to focus on. A defined contribution plan just means a plan where you and your employer put money in, and whatever it grows to is whatever you get. There are nobody making any promises for you on a number on the other end of any of this. You're just getting the outcome. That means you also get all of the risk. That was the quiet swap of the last 40 years, and nobody really threw a parade around that. The default landing spot for millions of these contributions is that target dated fund. Those funds, as I noted, those funds are significant. Those funds hold roughly $4.75 trillion by the end of 2025, almost entirely inside retirement accounts. So by the latest plan data, about 89% of 401k plans offer them. Roughly 7 in 10 workers hold them, and more than 40% of all money in the 401ks already sit inside of them. Now, why does this matter? This isn't a product category anymore. This is where the working life goes when nobody is looking. A worker picks a year. The year picks a recipe. The recipe picks index funds. And the index funds are the ones that pick the companies. Once again, for everybody in the back, you know what I'm going to say. The contribution arrived. The mandate was bought. No new opinion was required. That is the system. Now, as we move into the next part of this conversation, come forward to this June when Lapthorne releases the latest report. This is the second obituary. Lapthorne shows that the 20 biggest stocks in the global index are on average about 60 times larger than the average of the other 2,500 names in the MSCI. 60 times, not 60%, not 6D, not 6. The other 2,500 companies, 60 times bigger than the average of the 2,500 companies. These are not colleagues of the giant. These are in the service corridor of the building that the giants own. And the concentration is only accelerated. At home, here in the United States, the 10 biggest companies are now 40% of the entire S&P 500. There are 500 companies on this index. 10 of them are almost half the weight. We have not seen concentration like this since the 1960s. And spoiler alert, it didn't work out. You can look up the Nifty 50 if you want. You might want to pour another drink before you do so. You'll be fine. So when your statement says you own 500 companies, yeah, technically that's true. But the risk committee, if you had one, would tell you that you own about 10. And the other 490 are basically there just, we're going to call them decorative breadth, garnish, financial parsley. So before you email me, this does not mean that the market crashes tomorrow. The market can rotate and it can quietly swap yesterday's giant for tomorrow's giant and keep humming. This happened with Micron, okay? That is a reassuring version, genuinely. The market can replace one winner with another and keep absorbing every paycheck and keep changing the names at the top, and you would never feel the seam. But, and hold on to this thought, the machine only works this cleanly while the money keeps arriving. What happens when the largest generation in the history of capitalism suddenly decides to start pulling money out? That's a different question with a much worse answer. And it is also, spoiler, next week's show. I'm telling you now so that when you arrives to you next week, you cannot say I did not warn you where to stand. Now, the yardstick is the story. Lapthorne does this thing that ends the argument. He measures whether a manager beats the index consistently without taking crazy extra risks. And the finding is brutal. So I will keep this simple. In the world of finance and economics and statistics, when we do a survey, for example, we know that 37 is the number that you need to be statistically relevant, right? 37 participations to be statistically significant. And then in the world of skill, you actually need options. You need room to show up. If 10 to 20 giants decide the whole scoreboard, a manager can be right about 50 smaller companies and still miss his benchmark that year because the one giant it's that one giant that he missed, the one that he didn't like, the one that he said, yeah, this is growing too fast. Well, if that goes up 40% and it can drown everything else he got right at, if it's Micron and it goes up 600%, in 6 months, and he missed it, well, what do you think happens? So this is the type of thing that creates incentives that Lapthorne talks about that become a serious issue. Once again, if you miss just one stock, you're going to underperform. The public numbers on all of this are almost rude. In 2025, the spread between winning and losing stocks, how differently they moved, was the widest since 2009. The word here is dispersion. All that means is that stocks were behaving very differently from each other. Some were rockets, some were anchors, which in theory is Christmas morning for a stock picker. Maximum opportunity to be right. But when you translate this to the scoreboard, it ain't good because they lean on it. When I say a manager underperformed, I don't mean they lost money. I mean the index made, say, 10% and he made 8%. He made money, but he still lost the game by 2 percentage points. Okay? So in that perfect target-rich year, only about 30% of the stocks in the S&P 500 beat the index itself. And nearly 80% of professional large company managers underperformed. Over 5 years, that number goes to 90%. And over 20 years, it goes to nearly 93%. So what happens here is that this guy still won on research. He did a great job. He picked out good companies. He found value where there might not have, other people may not have discovered. He rotated into quality value at a time that was gutsy. He won the research. He did the research. He did his homework, but he lost to geometry. Do you understand how insane this is? Stop, sit with it for a minute. The stocks were all behaving differently, right? And the opportunities might be everywhere. It was the easiest possible year to prove that you actually had skill. And 9 out of 10 pros still lost to the machine that doesn't think. So how the hell is that even possible? How? I mean, because the index is not out arguing everybody. The index isn't smarter. The index has become the judge, though, and the jury. And a manager can find 20 genuinely different companies, great ideas. He can spot fake margins. He can find the companies that are awful. He can find the stupid acquisition. He can find the company that bombed 3 years early. He can find the CEO that spends half of the earnings call talking about his personal journey through artificial intelligence like it's a TED Talk, and he is actually Ted. But that doesn't matter. One giant has light. One giant just shines on everything else and overwhelms his performance. One giant that he didn't buy goes up 40%, 100%, 500%, and his whole year gets put into a cardboard box and left in the parking lot. He won the research. He lost the geometry. He won 50 arguments picking great stocks, and the benchmark owned the courthouse, the parking lot, the vending machines. It's not about skill being absent. It's the skill being outvoted by size. It's not a shortage of ideas. It's an avalanche of great ideas, actually, and that's kind of the sadness of it all. It simply doesn't weigh enough to move that scoreboard. So the manager found the right companies, and the machine said it was too small to count. That's the whole system right now. That's exactly where we are. That's why things feel off. Now let's go back a little further. Let's go back a full century. Because this is not new. That's the comedy of it all. There's that power law concept, the 20-80 Pareto principle. This is not new. It's structural. It is load bearing. Look at every stock. Zero Hedge did the analysis. 1926 to 2025, so 100 years. Something like 30,000 companies, and only 28% beat 1 month treasury bills over their lifetime. 28%. And the treasury bill is just the most boring, safe thing in existence, except when you leverage it up through the basis trade, but that's a whole other animal. This is the financial equivalent of a government-issued SOC. Roughly 60% of all those stocks did worse than the SOCs. All those stocks did worse than the sock drawer. Let's just make it cleaner. Now, that doesn't mean they all went to zero. It just means they all underperformed. After all that risk and all that drama and all those earning calls and all the CNBC hits and the CEOs wearing their vests, the investor would have been better off owning short-term government paper and going fishing. And 46 companies account for half of the $91 trillion in net wealth that the entire American stock market has ever created. 46. Here is where I have to hand the other side its strongest weapon, because I'm not a coward. 46 companies made half the money. That is the single best argument for just owning the index. And Lapthorne also notes, well, that's what people are doing. How do you trade this? What do you invest in it? Well, if almost half the winnings come from a tiny few and you cannot know in advance which ones they are, then yes, you should own everything so that you are guaranteed to own those winners. The machine is not stupid. It just built the one true thing. The one true thing, which is size. And size showcases this. But I want to note that there is a trap in this conversation as well, right? The honest version of that, of just own everything, you walk into a trap. And when the few winners are already known, already the biggest, already the mandatory destination for every dollar of automatic money, and now the default for government policy too, then the fact that used to be a reason to spread out becomes the reason everyone has now crammed into the same 20 stocks. The century-long lottery always found winners along the way. But now, oh boy, now what is new is that we have made winners compulsory. We took statistical truth about the past and then turned it into a law where all future money must go. So stock picking is not dead. Stock picking inside benchmark prison is dying. That is a very different sentence. And it's also a much more disturbing one. Now, let's get to know how completely messed up the retirement industry actually is, and how I feel bad for people like Brad Keswick. Now, before anybody speaks, one full sidebar, because this act does not land if you do not have these 4 words. And you're going to have them cold in about 90 seconds. Benchmark. A benchmark is the index a manager is measured against. It is his yardstick. It is the thing that his bonus lives and dies on. Underweight. That means he owns some of a stock, but less of it than the index does. If the index has 10% in a company and he owns 7, he is 3 underweight. He did not bet against it. He did not short it. He did not say it is a bad idea. He didn't talk any trash about the CEO. He just owns a little less than the rule book. It's a tracking error, really, at the end of the day. And I will not give you a formula because there really isn't one that you need to know. It's just a measure of how differently his portfolio behaves from the index. Pretty simple. Benchmark risk, and this is the big one, is the professional danger that he falls behind the index because he refused to own enough of one giant stock that he might think is a piece of shit. Benchmark risk is career risk, wearing a tie. And that is the whole translation. And here is the asymmetry that runs across the entire industry. Being wrong alongside everybody else is survivable. You keep your job, being right, alone, early. You can get fired before your thesis ever pays off. So nobody really ever stands alone, ever. It's not cowardness. It's just the fact that we've all got mortgages. Just how the whole world works. On top of that, you get a guy like Brad. And this is the man that the whole sentence describes. And this is why I feel bad for people who went into this industry with different sets of expectations and how much the ground has moved below their feet. Now, it's not going to be everybody, but for some people who are RIAs who are in this audience, you might feel this. Brad runs $4 billion of other people's money. $4 billion. Way to go, bud. He has credentials. Probably has an MBA. Definitely has a CFA. Definitely does all of his series analysis. Definitely makes sure that he is up to bat, following up on everything that he needs to do. Has a very good understanding of the legal ramifications, understands the law, knows his clients well, does everything right. 20 years of reading filings. He knows which management teams are lying. He knows which margins are fake. He knows which acquisitions are bullshit. He knows which chief executive used the word temporary the way that some of us use the word oxygen. Brad has genuinely earned his opinion, his right to it, and he believes every one of the biggest companies in his index is wildly overpriced. And Brad owns them anyway. He owns almost as much as the index does because he has to. Because benchmark risk is career risk. And Brad has a family and a mortgage and probably his own furnace. And here is where the story really takes a turn. Because I want you to meet Susan Vale, who works in governance. She is very important. She is a consultant. She does not pick stocks. She doesn't even like stocks. She might not even have ever even studied the market. But Susan understands math. She understands the difference between 10 and 7. She looks at Brad's process for picking stocks. And then she evaluates whether that process makes Brad's portfolio look too different from the very index that he was hired to beat. So Susan arrives with 2 laptops and 17 tabs open, and a couple of bottles of cucumber water that no one in the building requested or will drink. She's staying at a 5-star hotel. She flies around the country. She is probably only talking to her children through her phone. Might be a man, too. Just going to say that, but we've just chosen it's Susan Vale today. And Susan says the word governance. The instant the room develops a genuine opinion about anything, the way that a smoke detector goes off when something is finally cooking. And this is the term that I want you to think about. It's going to be some variation of this. Brad may say, we believe the stock is significantly overvalued. Susan will say, Brad, how underweight are you? Brad will say, 3 percentage points. And she will say, could you express your concern while owning a little bit more? And Brad will say, you want me to increase the position? And she will say, I want you to preserve the conviction while reducing its measurable existence. And Brad will say, you're just saying that you want me to increase the position. And Susan will say, we would call it governance-adjusted disagreement. This is a real term or a real idea. Governance-adjusted disagreement. Say it again in your head. Don't say it too many times, or you might slam your head first right into your desk. Your nose will bleed. We're not moving on for this one. Everybody stay right here. Once again, Brad thinks the stock is expensive. He told they will tell him to buy more of it. That is the whole event. That is the entire transaction underneath 4 syllables of consultant Latin. Brad said it's too expensive. Susan said, great, buy more. And they invented a phrase so nobody in the room has to say the sentence that I just said out loud. Don't let them hide the body in the vocabulary. Don't let 17 tabs and a bottle of cucumber water and a 70-page deck convince you this is complicated. Brad said no, and the benchmark said yes. And Susan built a process where the word no could be used to purchase more shares. What are we doing? What did Brad go to school for? Why the credential? Why the 20 years of filings? Why learn the value of a company at all if the only conclusion you are allowed to reach is one that looks exactly like the index? You could fire Brad. You could fire Brad and hire a coat rack. Seriously. You could hire a coat rack. Look at this word. Look at this coat rack. Put a navy blazer on a coat rack. Slide the index weights into the breast pocket once a quarter. Susan can wheel the coat rack into a conference room and ask it whether it remains comfortable with the tracking air, and the coat rack will say nothing because it's a coat rack, and it will outperform half the professionals in its country. And it will never once expense cucumber water. The coat rack also has no ego. The coat rack doesn't need to be right. The coat rack doesn't have a Substack like me. The coat rack has never once described its investment philosophy at a dinner party. The coat rack doesn't have a philosophy. The coat rack has a mandate, and the mandate is stand here, hold the blazer, do not generate a tracking error. The coat rack is going to retire before Brad does, and Brad went to Wharton. The coat rack came from a hotel supply company in New Jersey, and at the end of the year, the coat rack will probably be closer to the index. And I know what the defenders are going to say. I've heard it. They say, Garrett, you don't understand. This is prudent risk management. It's a fiduciary process. It is responsible adherence to a mandate. And I want you to picture the level of denial required here. Picture a sophisticated investor. Serious man, quarter zip, newsletter, 30 years in the business. He's attending the annual institutional allocation summit at a Courtyard Marriott near the airport. And this man would rather barricade himself inside the complimentary breakfast area with a waffle iron than admit the government's adjusted disagreement means buying more stock that he just called overpriced. Sir, do me a favor. Put the batter cup down. The waffle iron is not a fiduciary tool. Put down the tongs. The tongs are not part of the mandate. The tongs have never underperformed. Step away from the breakfast station and say the sentence. Just say it. The sentence is, I thought the stock was too expensive and I bought more of it anyway. That is it. You don't need another committee. You don't need a 70-page deck. You need to release the iron of the waffle and confess what happened. They did not take Brad's opinion away. That's the thing. They let him keep his opinion. They just quietly removed his purchasing power. He is allowed to believe the stock is overpriced with his whole heart, his whole soul, a little appendix, his quarterly letter, page 41, footnote 3, where his actual conviction goes to live out its retirement. As long as he keeps buying the stock, that is how institutions murder opinions. It doesn't argue with it. It just makes it too expensive to express. And this is not me being cute. This is literally what Lapthorne put on the page. Benchmark risk pushes big investors to hold stocks they don't even like, because being wrong on the other side, when those stocks keep rising, is too painful to survive professionally. So they hold, just to keep up. Brad is a hostage with a Morningstar rating. The benchmark was supposed to measure the manager, and the benchmark now manages the manager. That is where we are. And that brings us to our next character, and our next friend in this whole conversation outside of the coat rack is Martin Pritchard. He is at the table, and he is the saddest one. So I want to be careful with him. Martin Pritchard represents the pension. Martin needs 7.5% a year. Not once, needs. Okay? Huge difference. He needs it the way that a building needs its third floor. You can remove the third floor and improve the honesty of the blueprint, but people are already living up there. Martin will say, we just need a prudent process. No. 7.5%. 7.5%. Martin, you need 7.5%. Because that number was written down back when television sets had handles and every county employee retired with a gold watch and a defined promise. The number stopped being a forecast a long time ago. It has become a family heirloom. It gets passed down board to board, untouched, unquestioned, because the first person to lower it has to be the person that tells retirees and the taxpayers the truth. And nobody wants to be that person. So the number 7.5% just survives. And we keep saying it. The market is closed. Still 7.5%. The pension office is under 2 feet of water. Still 7.5%. The municipality has technically ceased to exist. We still need 7.5%. Martin is not an evil man. I need you to hear that. Martin is the human custodian of a promise that reality can no longer keep. And he knows it. These people know it. They carry it in a folder. The folder gets heavier every single year. Then legal starts speaking again, because why not? Legal has been quiet the whole time in a corner doing what legal does, which is worry about the minutes and the conversation. And legal might say to Brad, we would prefer not to write down the word overvalued that you used. And Brad would say, for my newsletter, what should we write? And legal will say, how about valuation sensitive? So the stock is not expensive anymore. The stock has simply developed a sensitivity. It's going through something. Give it some space. Give it some space. It'll be fine. Now, meanwhile, while all this is going on, over by the credenza, closer than last time, the raccoon has risen up onto its hind legs. Not to speak, it doesn't speak. It has just watched a man who is paid to have judgment get formally asked to buy more of the thing his judgment has rejected, and it wants a better view of this. Legal later will demonstrate that the raccoon is not loitering. The raccoon is location sensitive. The active manager did not lose his intelligence. He just simply lost his permission to use it. So, if judgment is trapped and the machine keeps winning, the obvious question is why anyone pays a human being for judgment at all, which brings us at last to Doug Wexler. And I need to protect Doug up front because Doug is not a criminal. It'd be too easy, and it would let the system off the hook to say Doug did really anything wrong. Doug is licensed. He is compliant. He files everything correctly. Dresses very well. He goes to conferences. He has a framed photo of himself standing 4 feet away from Alan Greenspan. He is exactly what the system asks him to be. And that is the problem with Doug. Doug puts his clients into 4 cheap funds. He rebalances twice a year, and he charges 1% of the whole account. He calls this, and I shit you not, the Wexler Integrated Wealth Architecture. Vanguard calls it 4 funds. Now, a little side note real quick. These are amalgams, these characters in this story. I hope you recognize this. There is no effort in any capacity to make this look like a real person. But we live in very interesting times, do we not? I'm telling you a story. So, first, a fund like this that Doug uses. You keep hearing ETF. I've used this a lot of times. It's very common. An ETF is just a basket. We talked a little bit about this with the leverage funds last week, but it's one basket that holds hundreds of companies and trades during a day, just like any other stock. That's it. It's a basket that you can buy and sell, just like a share. It's not magic. It's just a basket of stuff. Okay. Second, and this is the one that should make you maybe want to switch from mellow corn to coffee, the 1% fee. When Doug says 1%, your brain hears 1% of the profit. No, it's 1% of the entire pile. every single year when the account goes up, down, sideways, whether Doug does anything or does nothing, Doug takes 1% of the money, not 1% of the profit, the money. And again, that's 100 basis points. We covered that. So on a $1 million account, that's $10,000 a year for rebalancing twice. The baskets underneath, the ones actually holding the companies, cost about 10 basis points, which, using the word I already taught you, and I am not defining again, is the math of 10th of 1%. So the thing that actually costs a 10th of a percent, and the man who picks the things charges a full percent, 10 times more than the engine, to be the guy pointing at the engine. I'm not saying that every manager does this, but I'm just saying it's important to pay attention to how many basis points you give a manager. Just saying. But let's talk about Doug and the way that Doug talks about the funds and the positioning that he does. He might have things like Core, Core Plus, Strategic Core, and Tax-Aware Strategic Core Plus. Doug discovered 4 funds. Doug found 4 funds and named the discovery after himself, the Wexler Integrated Wealth Architecture. That is 4 funds. I can see 4 funds from here. I found them. I found them right now. I didn't charge 1%. I didn't name them after myself. I just looked at the screen, and there were 4 funds. And Doug has been doing this for 30 years. Nothing changed. Nobody changed. The companies are the same. The risk is the same. The top holdings are the same. Doug rotated a pie chart 12 degrees, and he added the word strategic. The rotation should not cost 90 basis points. This is not wealth architecture. This is an index fund wearing several lanyards. The basket owns the businesses. The index provider writes the rule book and licenses it. The platform holds the account. The record keeper processes the paperwork, and Doug selects from a pre-approved menu and might collect 1% because somebody apparently has to be there to explain the lighthouse photograph. Now, I want to point the difference out here. To be fair, and I mean this, I want to make sure that you're all not pissed at me yet. Let me teach you something. A real financial advisor can absolutely earn 100 basis points. I do want to point that out. I'm being a little bit flippant about certain participants. People who engage in tax planning, that is real value. People who engage in estate planning, that is real value. People who engage in talking a terrified member out of selling everything at an exact bottom, that is worth serious money. I have friends down in Texas, and they know who they are. These guys help big families deal with the crazy children who basically think they're owed something and are waiting for them to die. They help build trusts. They help ensure that there is a money plan in place. That stuff is real value, okay? So I want to make sure that I stress this. I'm not against advisors. I actually encourage people to speak to advisors. It's important. And that might be the most valuable thing that a person could do in the whole industry, might be outside of actually selecting ETFs. And those value-added components are very valuable. I can be against a full percent of your life savings every year for the labor of choosing 4 overlapping ETFs and turning around a pie chart, a 5-minute meeting every 6 months. I can't justify that. But if Doug does real work, Doug should open the books and show it. But if Doug does not open the books, well, Doug's probably going to open a marina at some point, just so you know, because here is where, if you have the wrong money manager, here is where your money goes. If you have the wrong RIA, if you have the wrong person who's not doing the work, and again, I'm not saying everybody, I'm saying these people do exist. Maybe it's a very small percentage, but you might be the guy holding the bag, and you might be the guy paying for the boat. Because Rick's money can go here. Doug owns a boat, and that boat is called Long-Term Perspective. And Doug named it Long-Term Perspective because the name he wanted, recurring fee revenue, made his wife upset. And I want you to picture the boat. I want you to picture the boat named Long-Term Perspective. I want you to picture Doug on that boat in a quarter zip with the marina key, looking out at the water, thinking about Rick's 1%. And I want you to understand that the boat does not know that Rick exists. The boat has never heard of Rick. The boat has no fiduciary relationship with Rick. The boat is not required to disclose its fee structure with Rick. The boat is just there. It's a boat. It's a boat on a water, fully funded, waiting for Doug to finish the quarterly webinar and come home to it. The boat is a sailboat from the pamphlet. The boat is what the pamphlet has always been advertising. The pamphlet was not advertising Rick's retirement. The pamphlet was advertising Doug's boat, and Rick paid for the photograph. The basket owns the companies. Rick owns the risk. Doug owns the boat. Which is one other reminder of how this market actually works and why this industry is difficult and why this industry has created so much pressure over time. Even the scoreboard is curated. Bad funds closed and they get merged away. And after 20 years, only about a third of the original funds actually remain. Meanwhile, the 4 largest fund companies have gone from controlling roughly 40% of the industry's money to nearly 60. The stocks are concentrated. The wrappers are now concentrated. The brochure, though, the brochure says diversification. Stick with that. Nobody really knows who lives in the house when it comes to this industry. But everybody sends an invoice. Everybody sends an invoice. Before I take another swing at this index, I want to be honest. I want to do the honest thing, and I want to make the other side's case as hard as I possibly can. With no jokes, because it is true, and it deserves to be said, and said straight. Passive investing rescued millions of ordinary people from expensive failure, from high fees, from managers who charged a fortune to secretly hug the index anyway, from pointless trading, from smooth-talking salesmen in nice suits who lost to a machine and still billed you for the privilege of doing that. Jack Bogle's revolution, low-cost ETFs, index-style investing, was a real, strong, wonderful revolution. It allowed an average person, a normal worker, a person with no Bloomberg terminal, no consultant, no RIA, no interest in annual reports and having to deal with all of that nonsense. They could own hundreds of great companies for almost nothing. It wasn't a scam. It was one of the greatest financial products, one of the greatest innovations. And I use that term usually as a joke. It was one of the great innovations for regular people, full stop. Okay? Translate those 2 words while I am still calm, because the whole rest of the act needs them. Active, okay? Active, passive, and active. Ugh. Here we go, okay? Active just means a human being is choosing what to hold. Passive just means the fund blindly follows a published rule book, an index. It does whatever the rule book or the prospectus says. That is the difference between the two. One is a human being that chooses, and one is a series of rules that must be followed. And that is where it all goes off the rails. The problem is not that the index failed. The problem is that it succeeded so completely that it stopped being a measuring stick and it became the operating system of the entire financial market. Okay? So, active to index funds, right? I mean, all of this stuff is very unique. We're going to break this down in a minute, but I want to point something out, okay? The money is already voting in this system. This spring, in a single month, U.S. stock funds pulled $10 billion, almost all of it, into passive rulebook funds, where the human chooser of funds bled out tens of millions of dollars. And the next month, the same thing happened. Rulebook following funds now control the majority of all money in U.S. domestic stocks. This was pointed out by the Bank for International Settlements. Passive flows were 19% of market in 2010. Last year, 52%. So the human chooser, that industry, it didn't just lose the philosophical argument. It wired the money to the winner, and it included a thank you note to the passive investment environment. And this is where the math leads out again. Mike Green, who is on Substack, yes, I give a fig, phenomenal economist. Mike Green has documented the engine of this for years. So credit to Michael. Great work. The engine has a scary name, and the term is market cap weighting. Weighting, W-E-I-G-H-T-I-N-G, not W-A-I. I can't even spell. Who gives a shit? I am going to make the scary name boring, because boring is how you defeat it. So here's your pizza, okay? Picture the index as a pizza. The biggest companies already have the biggest slices. That is where the index is, a pizza already cut, with the giants holding the giant slices. Now a new dollar walks into this market, okay? Rick's dollar, every other Friday. The dollar does not get to pick which slice it goes to. The dollar gets divided up according to the slices that already exist. So the biggest company gets the biggest piece of Rick's new dollar automatically for one reason and only one reason, because it's already the biggest. Nobody asks if it's a good pizza. Nobody asks what's even on it. Nobody asks if the company has made enough pizza. The rule book says biggest gets the most, so the biggest gets the most. And I got to be precise here because, again, I don't want any emails, but this is exactly where people online overreach and discredit the whole argument. The fund doesn't chase a stock by buying more just because the price went up. That's wrong. Don't say that. Don't say that I said that. What actually happens is the higher price itself makes the company a bigger slice of the pizza. It increases the weight in the fund itself. And then the next dollar that arrives gets carved up right alongside those bigger lines. The buying is not a chase. It is Rick's paycheck showing up on schedule and being fed into a pecking order that was already set, which is somehow calmer and much worse. Now, here's where the every buyer concept comes in. Once the machine sets that pecking order, translate one more term, price insensitive. Ugh. It just means the buyer is not asking whether the stock is cheap today. Price insensitive just means price agnostic, which means we're buying it. The rulebook fund does not care about the price. It's not shopping. It is obeying. And that price insensitive money shows up every 2 weeks like the tide, whether the giants are cheap or insane. So watch every other kind of buyer get pulled toward the same 20 names, each for a completely different reason. The rule book funds buy the giants because of weight. But this is where markets now shift, because it's no longer about how much is something worth. It's a matter of, do I have to buy it, and can I buy it? And that is where this concept of the every buyer thesis really becomes the every buyer constraint. Okay? So again, the rulebook funds will buy the giants because of weight. Human managers will buy because of the benchmark risk, which we already discussed. Brad can't afford to be light that stock, so he's going to match that weight. The global funds buy them because they are big and they're easy to trade. They're highly liquid, and if you need to raise cash, it's a lot easier to sell Apple than it is a $5 billion market capitalization that has a wide bid-ask spread. Regular people will buy stocks because they're names that they've heard of. The trend-following robots buy them because they're going up. Mechanical buying. Leveraged funds buy them because the prospectus says they have to. And none of these people may have ever met. They probably would hate each other at a party. I bet I would probably be multiple fights there. The buyers don't share a thesis. They actually share a constraint. And that's the key thing. That's the every buyer idea. This is where the work takes influence from Green's work, Green explains why the giants got so big. Every buyer explains why nobody can climb out from under them. A name like NVIDIA stops being a stock and eventually becomes a zip code, a place where money simply has to live, because choosing not to do it and being wrong ends careers, and every professional on earth knows this. And now is the part in the entire show that I have been walking toward. A machine this big has one real requirement: above earnings, above value, above everything. It needs buyers. It doesn't need opinions. It doesn't need analysis. It needs buyers. A steady, price-insensitive supply of money showing up on schedule forever. And this is the argument, very simply. When a machine has already captured millions of workplace accounts, pensions, institutional allocators, it can't stop. It goes looking for new buyers. And when it cannot afford to find any more grown adults to feed them, it manufactures them. Hold that sentence, because we're going to meet the newest buyers before this hour is over, and they will not be old enough to object. Now, in Q1, companies are in on all of this too. There is one more buyer, one more translation, and that is buybacks. A buyback is just a company using its own cash to buy its own shares off the market. Fewer shares left mean each remaining share is slightly bigger slice of the same company, which tends to lift the price, though whether it is actually smart depends on what they paid and what else they could have done with that money. That could have been putting money into CapEx. It could have been going out and buying another company. It could have been paying down debt. It could have been hiking the dividend. Okay? All fair. Now, in the first quarter of 2025, last year, S&P 500 companies spent a record $293 billion, actually, forgive me, $293.5 billion buying their own stock. In the third quarter, the top 20 companies were about half of all of that buyback. Over 12 months, buybacks and dividends together came in something like $1.7 trillion. So the rule book funds by the giants. The trapped managers by the giants. And the giants by themselves. It is a support group where everybody who comes and attends has to bring money. And I have to keep one more guardrail in focus, one more bolted down, because this one is true as well. None of this conjured these companies out of thin air, okay? This is genuinely enormous businesses with real products, real profits, real dominance. Fundamentals did make them big. But once they are very big, once they sit at the very top, size itself starts pulling in money just for size. Think about the companies that join the NASDAQ 100. Think about the companies that join different indices. Think about all of the new thematic ETFs that are created just because they exist, just because they are. And once again, by joining these things, they in turn become a reason to buy. And I go back to that one simple sentence that I made very early on in this entire conversation. The contribution arrived. The mandate bought. No new opinion was required. We shift our attention back to Lapthorne. Lapthorne is not a nihilist. He offered a fix. And for that, I appreciate it. It has most of Wall Street's name in existence. It is the concept of portable alpha. Hoo-hoo. What does that mean? It means the institution needs the market return, so it gets index exposure as efficiently as it can, sometimes using futures instead of tying up all that cash. That leaves capital and risk capacity available for a separate manager to make completely different bets, perhaps shorting weak companies, perhaps trading bonds, or exploiting price gaps. The index supplies the market return. The separate strategy tries to supply the extra return, and that extra return is the alpha. So the institution has theoretically carried over and attached to it the index exposure. It's called portable alpha. Now, most workers cannot build that structure inside an ordinary 401k. Rick gets a target dated fund. The institution gets the target date machine's sophisticated cousin, plus derivatives, financing short position, and a 31-year-old named Sebastian who says convexity while eating trout. It can be perfectly legitimate. It is also the whole class system in one product. Rick gets a workplace website with a password that expired during the pandemic. And the institution gets borrowed money, gets to bet against things, and escapes the gravitational pull of those giants. Wall Street did not solve the problem. It placed them in a second account and invoiced both accounts. Now, I want to point something out. The idea here of just indexing and then also trading momentum like we do makes the hell of a lot of sense, right? Because we have the timing mechanism in the market. We recognize 20-day, 50-day moving averages. We have those stocks that sit out on the bell curve that we can actively trade. We can take advantage of the waterfall effect that we discussed, right? Liquidity, momentum, mechanical breakdowns and breakouts, insider buying on the aggregate as a clue of when to buy the dip, and of course, keeping an eye on liquidity conditions and public policy actions. All of this creates opportunity as it emerges, and if you're paying attention to when momentum returns to a market after a sell-off, you will see the onset of the mechanical buying building, meaning if you were sitting on cash, this is your time to build and grow your portable alpha. Sounds like an idea. Maybe go to moneyprinterpro.com. Maybe check it out. Because again, the last time that we had this type of event was April 7th. Look at the SOXL from April 7th until about June 12th. That's the type of thing that we aim to trade to create portable alpha. But let's get away from that and talk about what else is in focus. Judgment moved upstream. And let me say plainly what has died because of this market. And I'm going to say it from my own earlier language, because precision really matters more than heat right now. And I keep saying the machine abolished judgment. It's not completely right. The true version is actually worse than that. Old investing was a specific human act. Study the company. Understand the return on invested capital. Look at their enterprise value to earnings before interest and tax. Look at the ROE. Look at the capital efficiency metrics. Understand, are they paying down the debt? Look at the Piotrowski score. Analyze the Z-score. Analyze the Benesch M-score. Estimate what it earns. Compare that to what price? Any price. Pick a price. Do it to relative value. Measure that PE ratio against the PE ratio of its major competitors. Buy the gap. Wait. That act still happens somewhere. What changed is when. We did not remove judgment from finance. We set one set of judgments up years ago, and we buried them deep inside of a product. And then the product became an issue, a thing that we just do on autopay. Judgment didn't vanish. It just simply got moved upstream. It got standardized. It got embalmed inside a mandate. And at that moment, that was the exact moment that enormous amounts of money got allocated. So on Rick's Friday, no new thinking is even required or even allowed. The allocation, the mandate, no new thinking is required. Valuation is still real. It's still taught in classes. I mean, gosh, NYU still has the best valuation metrics in the world. Earnings are still real. Companies still make things. They generate cash. They occasionally blow up, much to our entertainment. But those facts now have to fight a second market sitting on top of the first one. A market of payroll schedules, rule books, of benchmark fear, of collateral. And one more translation, how about the word systemic allocation, which is just robots that buy and sell shit based on price and trend and volatility instead of based on whether the company is any good. The old market still exists underneath. It just doesn't set the price by itself anymore. And under all of that, there is a floor that almost, well, very few people think about. And this is what actually is what I study. So let's get down to that floor and look at it and bring a flashlight and watch your head. In the cold open, I said we propped things up with the Federal Reserve. Here's what I actually mean by that. This is not a cartoon where the Fed buys NVIDIA. Let me kill any myth of that right now. The Fed is not buying stocks. It is doing something quieter and honestly more structural. It runs a hallway where it's almost impossible to tell the difference between the floor and the ceiling. Okay? So, a little bit of sidebar real quick. Let's go through 3 translations. Bank reserves, overnight money, and repo. Bank reserves are just the digital cash the banks keep parked at the Fed. So think of it as a checking account that banks keep at the Bank of Banks. Okay? Overnight money is exactly what it sounds like. One-day loans that banks and funds use to make sure the whole system reopens tomorrow morning without anybody face planning or lighting shit on fire. And repo, okay? Repo is the one that everything runs on and nobody explains. So I will. Again. Repo is short for repurchase agreement. It is a pawn shop. That is the whole thing. It is a big financial firm walking in, handing over a treasury bond, walking out with cash, and promising to come back and buy the bond back, usually tomorrow, for just a little bit more. Bond in, cash out, buy it back tomorrow. That's a repo. And then there's one more, right? That term, collateral. That just means the thing you hand to the pawnbroker so he is not scared to lend to you. So maybe if you go to a pawn shop and you take a guitar and you are given money and you're going to go back and get that guitar back later if you want that, well, your guitar is your collateral, okay? That's what he can likely sell it for. The treasury bond, in this case, is the collateral. That is the basement. Treasuries go in, cash comes out, and everybody swears they will all be back tomorrow morning. So the Fed sets a floor under what that overnight cash should earn and offers a place to go if the rate tries to explode through the ceiling. The market still moves. It just moves inside the hallway, and the Fed built the walls. Okay? This year, the Federal Reserve quietly went back to buying. Now, don't call it quantitative easing or else you'll get a nosebleed and fall down and hit your head on the floor. Don't do that. Don't do that. Since January, it has bought roughly $250 billion in short-term treasury bills. Don't call it quantitative easing. Don't call it money printing. It is. But don't do that. About $160 billion of that was to manage bank reserves, money in banks, right? We were just told that. The money that is being parked there, the money that the banks have, the money, the reserves, right? The reserves, again, is the digital cash that banks keep parked at the Fed. That's all you need to know. That's all you need to know. Don't overthink it, okay? All right, good. About $160 billion of that was managed bank reserves. Another 90 or so was from reinvesting money that came back from older bonds. Reserves sit at about $3 trillion. The balance sheet is now near $6.5 to $7 trillion. You can see that, the St. Louis Federal Reserve, if you want to see the Fed's balance sheet, which has been going up while they've been claiming that they were tightening. I want to point one last thing out. When the Federal Reserve rolls money off of its previous balance sheet, previous bonds that it owned, and it reinvests that money into the bond market, it buys things back. That is bond purchasing. That is support. That is bond buying. That is loosening. That's not tightening. They're still buying bonds. They're still buying bonds. I don't care what you call it. You can call it quantitative support. You can call it quantitative easing. I don't give a shit. They're buying bonds. Okay? That's the end of the discussion. Please stop sending me emails. Okay? You know who you are. Let's move on. Thank you. All right. Now, do not call it money printing to flood the stock market, please, because that is not the stated purpose. And the purchases are short-term in this case, the treasuries, things that are under 12 months. Don't call the $250 billion of bond buying nothing either, okay? The Fed is not choosing the stock. The Fed is choosing how much scarcity the entire system is allowed to feel. It is a dimmer switch on fear. That's it. And the Treasury is in the hallway too, issuing bonds to the system. And this is the other thing that people are missing. Please pay attention. Please. The Treasury is issuing the bonds the whole system uses as the pawn shop collateral. It is choosing to issue treasuries at the front end of the curve under 12 months. These are known as bills. 3, 6, 12 months. Okay. That is the primary collateral of repo. They are cash-like instruments. They are treated like cash in repo. That leads to more of this. That leads to more speculation. It leads to more fuel. It leads to more looser economic conditions. And the other thing that the Treasury will do is they will go out into the yield curve where there is a illiquid bond that is not selling, and they will just buy it back. They'll buy it back. Translate that before somebody tweets that the debt is being erased, please. It's not. A Treasury buyback does not buy down the national debt. The government just swaps older, harder to trade bonds for newer, easier to trade ones. And the ones that are easier to trade are usually at the front end of the yield curve. Harder to trade bonds for newer, easier to trade ones, just to keep the plumbing smooth. It is not paying off a mortgage. It is not reorganizing the mortgage paperwork so the dealers can still find a kitchen. The free market is still there, I guess. It has just been asked politely to stay between the velvet ropes. Now, the Fed maintains ample reserves, and Doug, the RIA, has maintained ample marina access. Only one of them has a formal operating framework, and every year I am a little less sure of which one it is. Anyway, back to the floor. Nobody is allowed to ask why the free market needs a sprinkler system, 3 emergency exits, and a standing committee on hallway resilience. Obviously, managing this and ensuring the proper flow ensures that bond yields remain calm and that we don't. Oh God, why did I choose to do this with my life? What am I doing? What am I doing? Let's get back to Brock. Let's get to Brock. Oh my gosh. It's too early for this. It's too early. Standing in the hallway of that Federal Reserve system that I just walked you through, levered to the ceiling tiles, is a man by the name of Brock Mercer. That's what we're going to call him. Brock is 32. Brock works a relative value hedge fund. Brock controls about $4 billion of positioning. And Brock describes his trade as market neutral. Because the phrase enormous leveraged bet on Treasury market created, in his own words, an uncomfortable recruiting environment. Oh my God, market neutral. Here we go. Here's what Brock actually does. It's so simple, it's going to make you angry. I think I was talking about this, and I think that Mike Batnick was like, why don't we just do this? I mean, you could. Anybody can do it. In fact, the Treasury Department would prefer it if you did. A Treasury bond and a futures contract tied almost to the same bond sometimes trade at slightly different prices. One more translation. A futures contract is just a standardized agreement to buy or sell something at a set price at a later date. That is it. That's all this is. Our whole financial system operating on shit like this. One more translation for everybody else. Once again, a standardized agreement to buy something at a set price on a later date. It doesn't flow. It doesn't flow as a song. I tried. It's not going to make it any more interesting. It is a promise with a due date. So Brock buys the cheaper one and sells the more expensive one, and he waits for the two pieces and the two prices to snap together, which eventually they usually do, and he pockets the difference. Here's the fun part. The difference is microscopic. We're talking pennies. 1/10 of 1%. So it makes pennies into real money, and Brock borrows an absolutely fucking insane amount to trade at enormous size. Here is the whole thing in one number. 0.1% on $10 million is $10,000. Cute. 0.1% on $10 billion is $10 million. So the trade doesn't just attract money, it demands leverage. And it's not worth doing unless you can leverage it gigantically. So where does Brock get the money to do it gigantically? He finances it through the overnight repo market that we just described. And every morning, he rolls the loan again, night after night after night. And that takes us to the math in this ballet of mathematical insanity. To translate the size, gross exposure on the left, because I'm about to hit you with some big numbers. Gross exposure just means the total size of everything Brock has on before he does the little dance where he argues that some of it cancels out. So Brock personally sits on $40 billion of it. Technically it nets $4 billion. Okay. Across the whole industry, it's something like $4 trillion of these leveraged treasury positions. Now, even if I'm wrong, whatever. Okay. Across the whole industry, these leverage positions exist. Roughly $3 trillion of it is financed in overnight pawn shops. The core trade is near $800 billion, but I have seen somewhere in the $1 trillion range. Big funds have nearly doubled their share of the whole privately held treasury market in under 3 years. All of it to a rounding error. We are at a rounding error. We are arguing over, and we are doing so at gunpoint. And this brings me back to the entire freaking premise of this, okay? They need demand for treasuries. China's selling theirs. Other countries are selling theirs. They're buying gold. Japan is in a pinch right now, right? Japan's in a pinch. They might have to sell U.S. treasuries to defend their currency. Cool. Who's going to buy it? Well, if the Fed buys it, that's quantitative easing, isn't it? We can't have that. So what if we just had a bunch of leveraged positions take them? What if we just had a bunch of massive demand created so that these guys can squeeze out their pennies in front of the steamroller? And those leveraged funds become a big source of buying treasuries to help suppress yields. And that basis trade, those $10 million on that $10 billion trade that I talked about, that just becomes the fee that we give them for being so gracious in buying our debt. What happens if it goes the wrong way? Don't think about that yet. Don't do that. Don't do that. Don't you think about that yet. Don't do it. We gave this trade fragility bylaws in April of 2025 when this thing sold off. We had a big event and there was deep concerns around U.S. debt. The Australian Financial Review interviewed Janet Yellen and they asked, what the hell was that about? And she said somewhere in her answer, well, we had a lot of leveraged funds starting to sell U.S. treasuries. And that was the extent of the conversation. There was no follow-up. There was no one going, hey, why are we doing this? Anyone? Why are we allowing hedge funds to? Why is the entire financial system at the mercy of the basis trade? And why is the Bank for International Settlements pointing this out, which they just did in their annual economic report that I just wrote about that nobody really seemed to cover back on the 28th of June? Anybody want to answer that? Hey, 60 Minutes. I heard you got some new people in charge. Hey, Barry, call me. I will handle the interview. I can't promise that society's going to like the interview that I do. And in fact, I would probably put a barricade around the Eccles building after I'm done talking about it, just because people might not like to know that the Federal Reserve and the Treasury Department and a lot of other people are allowing these trades that lead to a highly leveraged and extraordinarily dangerous financial system that if it does unwind and it does blow up, they're going to blame politicians, but in reality, they should have been blaming all of the government spending combined with the way that we are managing our debt and basically papering it over and making it look like it's not that big of a problem because of centralized activity to try to control the moved index and suppress bond volatility. You know what? I think I'll just go on vacation instead. I'm not going to bother myself with that. I'm just going to keep screaming out into the void. Maybe one day somebody will hear it. $4 trillion, $3 trillion of it borrowed overnight to collect what? A tiny gap, a rounding error. A rounding error, wearing leverage. Brock found a nickel on the sidewalk and purchased a forklift to pick it up. And the forklift is financed overnight. Tomorrow arrives, Brock refinances the forklift, and the lender says, Brock, are you certain about this forklift? And Brock says, the forklift is market neutral. And then the lender says, Brock, the forklift is $3 trillion. And Brock says, yep, but it nets. It nets. Brock has $3 trillion forklift, and his defense is that it nets. And everybody at the firm calls this market neutral. Market neutral. The man has $3 billion. There's $3 trillion in overnight borrowing, rolling every morning. Maybe it's it's trillions of dollars. I don't care if I'm even right, if the numbers are right. Sometimes I'm like, I think it's 1, 2. Maybe it's 3. Who gives a shit? It's such a big number. Don't get caught up on that. Like if you're sitting here going, well, actually, Garrett, it's 2.6 trillion, and I'm going to send you this report. Don't do that. Don't do that. Don't do that. Focus. Focus on what is in front of you. Don't allow some number to go, okay, we're going to get caught up on about $400 billion. Don't do that. Look at what is going on, okay? Look at what is going on. Look at what is happening every single night. Trillions of dollars rolling over every single day, and that neutrality depends entirely on every single lender waking up tomorrow in a perfectly stable emotional condition, something that I can't say I'm holding on to right now. That is not neutral. That is a hostage negotiation conducted in pennies. And here is the pawn shop of life for Brock, which is also somehow the foundation of your retirement. Brock walks into the treasury. Brock walks out with cash. Tomorrow arrive. Brock buys another tomorrow, then another. Brock does not have a 5-year plan. Brock has a highly liquid sequence of tomorrows. And this is the safe part. This is the basement underneath the entire fucking plumbing of $47.5 trillion. The lender earns interest. The dealer earns a spread. The clearinghouse earns fees. Brock earns the pricing gap as long as the financing keeps showing up. That is the mechanism. And here is the part that should make you care. In one sentence, no jokes. We got a live preview last spring in April 2025 when tariff stress hit. Something like $60 billion of these trades unwound in a hurry. Did they want to ask Janet Yellen a follow-up question? They did not. They wanted to ask her how her halibut was. How's the halibut? I don't know why my Australian has a Fargo accent. How's the halibut? Janet, how's the halibut? How's the halibut? That sounds like a completely different movie. That sounds like The Talented Mr. Ripley. How's the peeping, Tommy? How's the peeping? Anyway, lenders got scared. They demanded more collateral. The financing tightened, and Brock's beautiful market-neutral position started, in his words, expressing preferences, and then became temporarily directional, which in hedge fund land is, the building has picked a side that is not yours. This is not a quieter corner of Wall Street. In fact, this concept and this focus on repo has been the center of this entire market for the last 9 months. And credit to Logan at the Dallas Fed, who said the Federal Reserve has to focus on the SOFR. That is the secured overnight financing rate. That is the whole system. It is repo financing. Who gives a shit about the Fed funds rate? It doesn't control anything anymore. It's just noise, guys. The SOFR, even Powell came out and said we have to be committed to focusing on this. And that is why the standing repo facility doesn't have a cap on it anymore. And this is why the Bank of England is now going to have a lending facility that will touch non-bank financing institution. It's going to be the companies that are hedge funds, private equity, because they are the shadow system. And the shadow system of financing is bigger than the entire traditional banking system. But what do I know? Okay, so repo is the story. And we didn't remove the fragility. We gave the fragility bylaws. We gave it a board. We gave it a portal. We gave it a quarterly tabletop exercise and a resilience conference with a lanyard. And that tenant, that man buying tomorrow every morning, is the reason the Fed has to keep the hallway open. He is why the sprinklers exist. And this is why, moving forward, the rewiring of the system is happening right now. And that's what I've been writing about for the better part of 2 months. Let's look at some math. Let's change it up a little bit. Let's talk about the nervous system of the market. Everybody thinks about stocks and equities and picking stocks and going through that. And then they miss the point that all of these other incentives have been building around the system for the better part of 25 years. The SPY was the original ETF. That was 1993. There was one ETF, 1993. It was the SPY. Today, there are 5,500 ETFs, and there are only 4,200 American stocks. We have 5,500 ways to trade, 4,200 stocks. You think the ETFs might be influencing the idea of price discovery and maybe making that impossible? Yeah. Why don't we try something else? What else could be impacting price discovery? How about an entirely separate second nervous system that is impacting the entire financial system itself? An option is a trade. An option is a contract, forgive me. It is a contract tied to the price of a stock or an ETF. It is a derivative. It is derived, its price, from the underlying asset. Okay? So an option, again, if you don't know what it is, I have the opportunity, the option to buy something on or before a date at a specific price. It has to get through that price on or before. I now exercise it. I buy that. I buy those 100 shares of Apple because I owned a call option on Apple at $200 a share, and the stock is now at $205. That's it. Okay. A dealer who sells a contract doesn't want the risk. All right. So he buys and sells the actual stock to protect himself. That is a real trade in the real stock. And as the price moves, he has to keep changing that hedge. Depending on how the dealers are positioned, that hedging can calm the move down or shove it harder in a direction it is already going. In 2025, this market cleared more than 15 billion contracts, roughly 60 million a day. So on top of that market already jammed into 20 names, there now sits a hedging machine big enough to occasionally drive the very price it claims to just be watching. The side bet starts trading the thing being bet upon, and the casino begins moving the horse race. The insurance policy is now moving the house. Puts are supposed to be insurance, right? Calls are supposed to be something that gives me the option to do something. Well, now it's just becoming a money-making mechanism. It's becoming a way to trade. It is becoming a way to move quickly under pricings under the underlying asset itself. It's not based on the traditional way that futures and contracts were created. I mean, remember, the entire futures market was, particularly in agriculture, was built because the Great Lakes froze. How do you move grain from Minnesota to Chicago and everything's frozen? You don't. Part of the reason, it's not the full reason, it's a reason. CME was there. Read the book, The Futures. It's a great book. It explains it all. It was so that you could contract, grow grain now and know that you have a price waiting for you in 9 months. That's what it was. That's not what this is. This is a totally different thing. Totally different. Complete distortion from what the original intentions were. Okay, but the insurance policy can start moving the house, and that's what's happening. The tail has a gym membership now. So we look at this, and now we talk about the full pileup of all of this. Everything has been defined. No more teaching. Breathe. So now, and only now, watch this whole thing move at once. Rick sends $312.64. That money leaves before Rick ever sees it. Doug selects the model. The model selects the ETF. The ETF selected the index. The index selected the giants. Brad selected against the Giant quietly in his appendix, but Susan selected against Brad. Martin selected 7.5% because reality was not on the menu. Legal selected a softer adjective. The company bought its own shares. Brock bought the Treasury. The pawn shop bought Brock another tomorrow. The Fed bought the bills. The Treasury reorganized the collateral. Dana disabled the chat. Doug rotated the pie chart. Doug's boat issued an outlook. Susan opened the 17th tab. Martin reviewed the assumption. The assumption remained 7.5%. The furnace filed a competing claim. The furnace was denied. The raccoon was added to the distribution list. Nobody knows who actually added the raccoon. The raccoon is the only participant here who is not billing by the hour. The raccoon, we'll check back in on him in a minute. Dana, of course, Dana, remember her? The benefits manager? She re-enabled the chat just long enough to paste a link for Rick to the recording. It had a sailboat background. And the recording requires a password. And that password is sailboat 2055. Doug's quarterly letter explained that recent concentration efforts, disciplined, it reflected disciplined market leadership. He's struggling to even get it out. His letter, because he is not allowed to have an opinion anymore. He will explain to his readers. He will explain to his clients. He will explain that recent concentration efforts in his portfolio, why he is doing the things that he is doing, reflects his discipline and the disciplined market leadership of the firm. And Susan and her cucumber water come in, look at the draft, and removes the word concentration. Legal replaces that term with leadership breadth. So now it says that recent leadership breadth reflects disciplined market leadership. And everyone signs this. Everyone was compliant. Everyone will tell you with a straight face that the market you just watched reflected millions of independent decisions. And it doesn't. It reflected a single paycheck being processed by 20 institutions that have all quietly agreed to never call a machine a machine. Because the reality is that all that really happened was that one paycheck entered a hall of mirrors. The contribution arrived. The mandate was bought. The manager complied. The benchmark won. No new opinion was required. Now, everybody calm down. Everybody put their hands where I can see them. I have to stop one more misunderstanding before it burns the house down. I'm not telling Rick to sell his index fund. I want you to hear me out on this, okay? For most people, cheap, broad index funds is still the least bad, most principled thing available. And if you walked away from the show and did something dumber and more expensive, I have failed you. What I am telling Rick is that the product is not neutral. The plumbing around it matters, and owning 500 tickers is not the same thing as actually being spread across 500 different risks. So here is the operating manual, translated because you cannot out-research 2,500 companies from your phone, and you should not try. We are learning to see this machine, not out-argue it. Liquidity is how much money and willingness there is to trade is available without price snapping. Liquidity is also all of the capital and credit in the global financial system itself. When it is everywhere, shitty companies rally. When it dries up, even good things get sold because somebody somewhere needs cash right now. When liquidity dried up during the 2024 downturn in the Nikkei, during that period of time, NVIDIA fell 33%. From mid-July 2024 to the bottom in August 2024, it fell 33%. The thesis on NVIDIA didn't change. It was a liquidity run. Okay? That's important to note. Momentum means The price is moving one direction and keeps going. And the way we measure it is on the aggregate, the number of stocks in breakout mode versus breakdown mode. And when we bring it down to one number, positive or negative, we tend to see that when momentum is breaking into the negative, that is also aligning with liquidity drying up. And that is where we have these panics and people freak out. And then we have to wait for the Federal Reserve, the Treasury, or somebody else to step in and try to cool off the bond markets, particularly the repo system. And that jackass with his $4 billion market neutral fund. Okay? Breadth just means how many stocks are actually participating in the rally. If the market is green, but everything under the 10 biggest names is quietly bleeding, that is not strength. That is 10 giants carrying 490 exhausted people up a hill. Positioning tells you whether the crowd is all on one side of the boat. Okay? So here's the whole doctrine. Fundamentals tell you what deserves to survive, but shit survives. Bad things survive. Liquidity tells you whether the water is rising or draining. Momentum tells you whether the buyer is actually there. Breadth is telling you how many companies are actually in the game. Positioning tells you whether the crowd might panic. And risk management, which is the heart of what we do, is the only thing that keeps you alive when the machine runs in reverse, which, as of next week, is a whole show. And the final irony in all of this, from Laborn's own report, in the very note declaring that benchmark stock picking is becoming pointless, his momentum measure, just buying what is already going up, was up about 30% for a year. Value, buying the cheap stuff, was up around 12. So, while the whole industry argued about which companies deserved to win, the machine had already quietly told you which ones were winning for no reason other than everyone else was required to keep buying them. Momentum did not explain why. It just confirmed where the buyer was and who the buyer is. And a portfolio full of famous names is not diversified if every single owner bought them for the same invisible reason. Now, we are moving into our final two parts of this conversation. And that brings me to this. There is one more buyer, and this one changes the whole shape of this story. Because while all of this has been running, on the 4th of July, the Treasury announced something called Trump accounts. And I am going to be fair at first because the gray version concedes the good part before it swings. For qualifying kids born 2025 to 2028, those families who sign up, the government drops $1,000 into an account for them. Families, employers, and states can add up to $5,000 a year. Ownership matters. Compounding matters. A cheap index fund is genuinely better than some expensive garbage stuffed with hidden fees. And handing a lower income kid a real asset at birth can help a family build wealth it would have otherwise never been able to touch. That is a real cause. I am not going to pretend that in a way, and in many ways, I advocate for it. I'm going to put up the legal fence now before the reveal so nobody can use it to interrupt what comes next. These are private accounts. They are opt-in. They do not divert from your payroll taxes. They do not fund the Social Security Trust Fund. They do not cut anyone's Social Security check. Not $1 goes into the trust fund. These are private accounts for children. This is not a financial rescue of the old system. All true, all conceded. Fences up. And at the launch, the default investment is the S&P 500 fund. Of course it is. The one buyer who could not possibly choose to enter, the government just delivered it swaddled. And to understand what we actually have built here and what we are building, I have to give you a different story about a very different weapons program. We need to talk about the Manhattan Project. Not the one from the movie, the other one, the financial one. Because about 50 years ago, a group of extremely serious men decided to build a weapon capable of destroying the American mutual fund industry. And the target deserved it. Managers charged a fortune and lost to the market. Brokers sold garbage with a handshake. A man in a nice suit would put your savings into General Electric, Exxon, and a regional bank and bill you 2% a year like he had decoded the human genome. So a man named Jack Bogle built a device, the index fund. Clean, democratic, cheap, unkillable. It did not try to beat the market. It became the market. It charged almost nothing. The industry laughed at it. They called it Bogle's folly. They called it un-American. They said settling for average was a surrender. And then the device detonated in slow motion over 40 years. And it turned out that owning the average at 1/10 the price beat most professional claims of brilliance sold at full price. The salesman lost. The carnival closed. Regular people finally kept far more of their own returns. The device worked exactly as intended. And then we did what America always does when it decides that a device works. We connected almost everything to it. What if we put the pension system and millions of workplace accounts inside it? What if we wired it to the paycheck? What if enrollment happened automatically so the worker did nothing and the device bought anyway? What if we linked the advisors, the trustees, the benefits departments, the options dealers, the federal policymakers, and, hold that thought, the newborn American babies to the same machine? Nobody voted for this. There was no ribbon cutting. There was a law in 2026 that blessed a default fund and a payroll system and 40 years of quarterly decisions that all made sense at the time. And that was the Trinity test, not the first index fund. The first index fund was just the physics. The Trinity test is automatic enrollment plus the target date default. That is the moment the device became self-feeding. Rick does not know he has joined a national weapons program. He thinks he enrolled in his county retirement plan. Rick clicked 2055. Somewhere beneath Pennsylvania, a reinforced door has closed. The paycheck arrives again. The contribution strikes the target dated fund. The target dated fund strikes the index. The index strikes the largest companies according to their existing weight. A flash flashes over New Jersey. A Vanguard representative quietly removes his glasses, and someone somewhere whispers, "My God, the expense ratio is almost nothing." Millions of new contributions arriving every 2 weeks from American paychecks, then another, forever. The chain reaction is not powered by conviction. It is powered by payroll. Oppenheimer needed uranium. This thing runs on Fridays. And from that morning forward, every institution in this country has repeated one official sentence. And I want you to listen to it to see if it's less true every time I say it. The 10 largest stocks approach 40% of the S&P 500. The chain reaction remains contained. Professional managers buy companies they privately believe are overpriced because being underweight the giants is career death. The chain reaction remains contained. The target funds keep buying. The companies repurchase their shares. The momentum systems follow the move. The options dealers adjust their hedges. The Fed keeps the funding hallway open. The chain reaction remains contained. And Rick raises his hand and asks, what happens when millions of retirees stop putting money in and start taking money out? This is where Susan speaks, and she says that scenario falls outside today's containment presentation. Now the scientists, because the movie is really not about the bomb, it's about a hearing. A man in a small room under a bare bulb interrogated the crime of having doubts about the device. And we have that hearing. It happens every quarter. It's called a portfolio review. Brad is the scientist who knows. Brad ran the numbers. Brad believes one of the giant companies is dangerously overpriced, and Brad can show his work. So they put Brad in a small room And Susan turns on a light bulb. Susan, how underweight are you? Brad, 3 percentage points. Susan, are you now or have you ever been underweight this company? Brad, yes, on the evidence is right there. Susan, your evidence has been incorporated into the appendix. Brad, you are ignoring my conclusion. Susan, we value your scientific contribution. Brad, the device may be unstable. Susan, we are comfortable with the device at the benchmark weight. Brad is permitted to object to the device as long as his objection has no bearable, measurable impact on the device. Oppenheimer lost his clearance for having doubts. Brad keeps his clearance on the condition that his doubts never touch the money. And around the crater, an economy formed. And that is exactly what takes us to our ending here. We're going to wrap this up. It's been a while. I appreciate everybody's time. Let's go back to Doug. Okay. Doug, once again, Doug does not, in any capacity, have a scientific role. He did not split the atom. He just sells tours of the test site at this point. Doug takes 4 index funds, the actual device, which costs 10 basis points, and he arranges them around a pie chart. He rotates that chart 12 degrees and charges 100 basis points for what he now calls the Wechsler Strategic Containment Architecture. Doug has temporarily renamed his quarterly webinar Controlled Reaction. And the boat remains called Long-Term Perspective because the vinyl lettering was really expensive. And he is collecting a recurring consulting fee now just to point toward the mushroom cloud. We're going to wrap it up here, okay? Here's the part that I want you to hear, because it's not an allegory. It is the historical record. And the two records rhyme so much that it actually should bother us. Oppenheimer became a warning about what happens when the scientist begins questioning the direction of a program. The state stripped him of his clearance and turned his doubts into evidence against him. In his final public warnings, Jack Bogle warned what concentrated index fund ownership could become. In a Wall Street Journal conversation months before he passed, the inventor of the index fund said that if these trends continued, a handful of giant corporations would one day control the voting control of essentially every major large corporation, and that he did not believe that such concentration would serve the national interest. BlackRock. His words. The inventor looked at what the device had become and filed a public objection. A public objection. And the industry's response was the same as Susan's. They valued his scientific contribution. They sent flowers. They incorporated his conclusion into an appendix. And then the industry kept feeding that device. So the device works, and the scientists are contained, and the inventor is in the appendix. And the machine needs one more thing that it has always needed. Buyers. And when it ran low on adult participants, this 4th of July, the Treasury of the United States walked into a maternity ward carrying $1,000 and a prospectus. That is proliferation. We built a bomb to destroy excessive fees. Then we put it through workplace plans, then pension portfolios, then every advisor's pie chart, then every policy conversation in Washington, D.C. And now it is federally seated and swaddled. Sophie is 7 pounds, 4 ounces. She cannot control her neck. The chain reaction remains contained. She hasn't learned that her hands belong to her, but the account has already purchased the largest companies in America at their existing weights. No questions asked, none taken. We achieved financial proliferation before object permanence. And now, I know, it is the line that you all want me to say. So fine. I will do it once. Now I become benchmark destroyer of price discovery. It's too dramatic. And the show always corrects itself. The price discovery is actually not dead. It has just been relocated to a secure facility where Brad is allowed to practice it under supervision so long as he keeps buying the stock that he believes is overpriced. Because here's the actual bomb. It was never hiding in indexes. It was never that indexing exists. Indexing is genuinely a great invention. It is a great innovation. And if you sell your cheap index fund because of this show, I have failed you, and Jack Bogle's ghost will start to haunt my property. The bomb is that the American retirement system, millions of paychecks, institutional policy, and now the bassinet has been organized and reorganized around one assumption. And that one assumption is that the chain reaction must continue forever. The index fund did not fail. It succeeded so completely that failure is no longer permitted. Yes, the stock market is too big to fail. We did not destroy Wall Street. We democratized the blast radius. And I'm sure you remember the scene at Trinity. The scene at Trinity the night before the test, the physicists start taking side bets on whether or not the device will actually ignite the atmosphere and end all life on Earth. And the official calculation comes back, and it says the chance is near zero. We have our own version of that calculation. We have models for retirement, withdrawals, glide paths, actuarial schedules, simulations showing the system can process the transition in an orderly way. The largest generation in American history will now move from contributing to withdrawing through the same broad demographic window on an actuarial schedule that you can already see coming. The assumptions say the machine can handle it. The official answer is that the risk is manageable, which is not the same thing as zero. Brock, for what it is worth, is taking side bets in the parking garage. And the raccoon? Oh, glad you asked. Out past the site. At the perimeter fence, the raccoon is sitting very still. It was issued goggles, but it did not wear them. It is the only participant in the entire program who looked directly at the blast. It has filed no report because it bills no hours. And so we end at the pond. Two men, and the younger one says, when I came to you with those calculations, we thought we might start a chain reaction that would destroy the world. And the old man says, what of it? I believe we did. We did not destroy Wall Street. We democratized the blast radius. Near zero is not zero. Stay positive.